Yeah, so for founders who may not know your firm yet, could you give us a quick overview of FF Ventures, what you guys focus on, the type of companies you back, and the typical stage and check sizes you invest at?
Yeah, so FF Venture Capital is an early stage venture capital firm. We've been around since 2008, so we're in our 18th year. We're highly engaged. We tend to start at the pre-seed level, so think $500,000, $1 million checks, follow on deeply until about a Series B, and then hold on 1 second, and then we stop investing. So we like to capture that early state, that early sort of alpha stage of investing. To give you some stats, about 50% of our pre-seed deals go on to raise a Series B, and we've had 13% of our companies get to 100 million revenue run rate. So we have very high survivorship. We're running a few standard deviations on both metrics beyond the average. We have an office in New York in the Empire State Building. We have an office in Warsaw, in downtown Warsaw. We've been there for about 6 years now. We have 2 funds in Europe. We have 6 funds in the US. We're raising a 7th fund in the US and a 3rd fund in Europe. And our 7th fund in the US is focused around energy and manufacturing sectors, the sort of reemergence, rejuvenation of US energy and manufacturing. And we think there's lots of interesting things, obviously the application of AI, which is an area we've looked at for over a dozen years, through to the intersection of various technologies. We think 3D printing is going to become fascinating as and really come into its stride here.
Okay, and this is all in regards to the 7th fund you guys are currently raising. That's where it's going to be focused on.
Correct.
Okay. And talk to me, I want to know, what do you think separates founders who successfully raise venture capital from those who struggle to get any investor traction?
Well, most founders don't raise, and most founders who raise fail. So you've got to start there. I think, I use this term that successful founders are delusionally optimistic. They believe they can change the behavior of millions of people to adopt their product, to look at the world they do. And that doesn't mean everyone who's delusionally optimistic makes a great founder, but they really have to have a unique way of looking at the world. They're a little unreasonable. Reasonable people don't get things done. Unreasonable people kind of do. And generally, founders are good storytellers. They can explain what it is they're doing. And generally, they're good salespeople. They can convince people to look at the world the way they look at it.
Okay, I appreciate the detail. Gives us a good kind of idea of what the ideal founder is when you're trying to raise capital and just in general. And for the stage that you guys do invest at, so you said anywhere from pre-seed to up to Series B, what metrics matter most to you when you're looking at a startup?
Well, I mean, sometimes we invest before the company is formed or even before metrics. So we can be very early. Most businesses are arbitrage, and they have a cost of acquisition. They have a lifetime value of their customers. So you really want to understand why they would have unusually low cost of acquisition relative to lifetime value. And that can come from domain expertise. It can come from business model, come from a number of aspects. And we don't expect them to have barriers to entry day one, but we expect them to be able to build those barriers to entry. So how do they look at that? We like early revenues, not just because revenue is your cheapest form of capital, but because it contains enormous information content. People are willing to pay to do A, not do B, so you probably do more A and do less B. So we think early revenue is a really good signal. And so we kind of look at that. And we like business models. So we like businesses that kind of work. We're not really interested in selling dollar bills for 60 cents or 90 cents. We're really interested in companies that can put together a meaningful business. And so understanding how that would work is important. And generally, you want to have a solution that is either 10 times better or 1/10 the price of the alternative. Because people are stubborn in what they do and you need to change their behavior. So it needs to be a massive incentive to do so. And you can look at, a number of things that have come along. And when you really look at them, they kind of hit those kinds of metrics. I can give you examples, but that's kind of what we look for.
Understood. I appreciate that. And in regards to the startups that you are looking at, when it comes to due diligence, what are the most kind of common issues that you see that kind of slow down or even kill deals?
So we do pretty deep diligence. We when we invest at the pre-seed level, we'll do a series A level type of diligence. And we do that because we want to take away the diligence risk for later investors. And when we refer a company for later rounds, we want to make sure it's really clean. So our diligence list is incredibly long. We describe it as somewhere between a proctology exam and a colonoscopy. It's a long checklist. And where do companies tend to fail? Often they don't have their paperwork in order. Often they don't really have their numbers in order. We're actually big on numbers. We think, it's very rare to find a CEO who has an accounting background. And if you did, they probably wouldn't have the right risk profile. So, we want to make sure the CEO has good management accounting, not just GAAP accounting, at his or her fingertips to be able to navigate the business and understand how the things fit together.
Okay. And when you say the numbers, you're talking financials, as in historically speaking, or even projections for the future?
I'll give you some dumb examples. When you have a two-sided marketplace, it's very difficult to think through cost of acquisition or lifetime value because you have to grow both sides and where you spend the money and what's the return on that money. If you have most companies require working capital. Some companies have negative working capital where they get paid the money before they have to pay their cost of goods sold. And what you find, and this feels counterintuitive, if you have a high growth company with negative working capital and the growth slows, the company can run out of money without realizing in 2 or 3 months. So this is what we mean. We think it's important for the CEOs to have good numbers to manage the business through cash management, not just GAAP reporting on an accruals basis. I suspect the dirty little secret in venture is about 10% of companies fail because neither the VCs nor management had a good handle on their accounting numbers.
Okay. I'm assuming that's something FF takes pride in terms of looking at the accounting.
In fact, we're the only VC firm that built an accounting firm called Graphite Financial, which we spun out a couple of years ago. When it got to like 30, 40 people, it was more than a side project.
Nice. Okay, and tell me, when a founder does reach out to you, what makes you actually respond to their outreach and take that first meeting?
We get a lot of outreach. There's a simple filter. Does it fit our portfolio, and is it not competitive with anything in our portfolio? If it's competitive with something in our portfolio, we're obviously not going to look at it. And I would say founders should do their homework first, making sure it's stage appropriate, sector appropriate, not competitive, all those dynamics. All right. But it's where when we look at it, we think both the people are strong and the space is of interest to us. And because we're trying to invest in things that we think will be important 5 years from now, it's really difficult to give a list of things. And honestly, if if someone comes along that just feels they've been very creative in working out how to get to us, they'll get some extra brownie points for that. In addition, we very much where we have disadvantaged founders that approach us, we listen a little bit more intently. But yeah, I mean, we did the whole idea. You've got to be open to things you don't know.
Yeah, for
But
sure.
particularly in the early stage. When you're in later stage, you can say, I like this drone delivery space. Let me go and look at all the drone delivery companies. And you can run screens, you can get your analysts to go and call them up and put together tables. It's much more quantitative. But in the early stages, you just don't know. I mean, we invested in the drone delivery space 6+ years ago when it seemed insane. Now it just seems mildly insane. Yeah, but it's a hell of a business for sure. But yeah, you've got to be willing to listen to the crazy.
Yeah, good way to put it. And on that note as well, talking about listening to the crazy, what major shifts are you kind of seeing right now in venture capital the founders should understand?
So, I mean, there's a whole series of stuff. Firstly, the costs of doing business are changing dramatically. So you can do a lot more with less. Now, I've always said, the guy or girl sitting on a couch with a laptop in front of them could be building a startup or shopping on Pinterest or whatever. It's the same tool set, right? And you go back 25 years, you needed a room full of Sun servers, you needed your own PABX, etc. Everything's been turned from CapEx to OpEx, and the cost of starting a company has come down. But these large language model derivatives are really allowing people to do so much more with less. It's really fascinating what people are able to do. So, and that's a two-edged sword, because any business you built, a few years later, someone could probably build the same business cheaper. I was talking with a founder earlier today about a particular problem. He goes, to solve this 3 years ago, I kind of needed 5 developers and it would take me 6 months. Now I think I can do it 6 weeks with a Claude bot. And, so the cost is a lot lower. The type of people you hire are different now. It's not just domain expertise, but it's domain expertise intersected with someone who really understands the tool sets that exist today and has a listening ear for the tool sets that are coming out. So, enormous change, enormous creative destruction. A lot of companies that probably got founded last year now are just features embedded in, Anthropic or OpenAI or Grok, as just a new capability that's been released. So you had that going on, and it also means you have to think where the value is in the stack. Right? Is it in the AI model? Is it in the application that sits on top? Is it in other applications? Like, how do you think about those kind of dynamics and what's available? I'll give you a simple example. SaaS used to be, you come into my data center, you use, I partition it for your company. People log in, I give them a dashboard. In the world of AI, okay, maybe I give you the dashboard, and then maybe on top of the dashboard, I give you a prompt, the command line prompt that you can type in and ask, query the data, right? But in reality, you probably want an agent swarming across your data to really look for anomalies and every now and then send you a message and say, hey, I found this really strange thing with your customers, right?
Yeah.
You couldn't do that before. And then what if you actually had a chat bot that's on your Slack, that's listening to all your conversations, then interrupts them and says, hey, you were talking about sales in Chicago. Did you know sales dropped off in Chicago last week? Click here, and here's a link to a report that I've dynamically generated based on the chatter you guys were talking about. Right? So I think the nature of what customers want will change, and we're moving more from static software control panels to being injected into the workflows with AI and humans interacting within their workflows. So I it's a change. And if SaaS companies don't adapt to this, then they don't deserve the multiples. But if they do, they start off as being this single source of truth of data on which you can then build these workflows and services on top.
Yeah, that was really insightful because obviously all founders should be thinking from the perspective of the customer, what they want and what they'll be looking at in a year or so or two. And it's SaaS, so you could be easily outplayed by another player in the market, and all of a sudden, no more MRR coming in. Okay, I appreciate that. And I want to ask as well then, what are the kind of three biggest mistakes that you are seeing founders make, especially when they're raising capital?
Okay, so the first one doesn't sound big, but it's my biggest pet peeve. 80% of the time, they don't number the slides.
They don't number the slides.
Yes. So
How
you're in
does
a
that work?
conversation with someone, you go, let me turn to slide number, that one, right? So, but I think it's raising capital is a big game of concentration. And so, first thing is you need to have enough people in the pipe to raise capital. Secondly, you need to make sure that you are listening whilst you're selling. You're trying to understand what it is the investor is really looking for. And you need to be able to explain the story. I will tell you, most founders are not able to explain what it is they're doing in one sentence such that a 4-year-old can understand it. Right? If you go the Airbnb for beach clubs, or the A for B is an awful way to describe it. Right? So what is it you're doing? What are you enabling? And you'd be surprised how many founders stumble over just the simple ability to explain what they're doing. They can't see the wood for the trees sometimes because they're so close to it. So, earlier I referenced storytelling, but it's really a big part of storytelling is this ability to explain what you're doing. And then the last thing is you find an investor and they want to give you money and you don't realize they're a jerk because you didn't go and get references. So reference your investors. The average investment in a startup lasts longer than the average marriage in the US. And it's more difficult to get out of. So kind of like just reference your investors and make sure that they're the kind of people you want there. Because sometimes times are good, but sometimes times are bad. And when times are bad or tough, you want to make sure you're working with people that you really want to work with.
Yeah, great analogy. I think a lot of startup founders, because they're so focused on the capital, they jump into the marriage, no prenup. So divorce looks really messy, and it's even harder to get an annulment. But okay, I appreciate that. And John, we have a segment at the end that I want to get your thoughts on. So essentially, it's called Please Stop, Please Start. And what I want you to do here is tell me something you want startup founders to please stop doing. I know you've mentioned a number of the slides as one of the things that they should please start doing. But you could pick another one for please start as well. So it can be across anything. It can be anything to evaluation, due diligence, outreach, anything. Yeah, just one thing you want founders to please stop doing, and another thing you want them to please start doing.
So I'll give you a stop and a start. As I said before, they really should reference people they take money from. So that's that's in the please start. The please stop is don't just focus on the value of a round. Think of it. If you're going to win, you want to win the war, and the round is a battle. So if you optimize for the battle, you can lose the war. And a simple example is you raise money at the highest price possible and the most amount of money may not be the right strategy, because you need to make sure you execute to get to the next round. People think dilution is what they take on the round. Dilution comes from how they spend the money in the interim and what the companies then has to take money in to get to the next stage. So the dilution is how you spend the money, not when you raise the round. And sometimes it's better to raise a smaller amount of money at a lower valuation, particularly if you're raising from people you can think can be very additive, as opposed to optimizing to take lots of small checks from at high values from a large group of people. Those party rounds rarely work. And you're trying to be the 1 in 100 that gets to 100 million revenue run rate. What is it you can do to give yourself an unfair advantage? And so optimize over the life of the company, not necessarily round by round.
Okay. And you did mention valuation there, so I would love to get your take on this. How do you either, I don't know if FF have like a standard way they approach it, or you have a personal way to do it, but how do you actually value a company? Like, what are you looking at and focusing on when you're valuing a company? Are there models that you're looking at? Maybe a VCM, the DCF?
No. The VC has the unfair advantage because they see so many companies. So, we have a sense of value of what we're willing to put capital work. And capital is not just our money, but it's also our time and energy and reputation. And we have a value at which we want to be able to do that. And the founder has a number in mind, and usually we're able to find a way to reconcile the two.
Okay. That's a generous way to put it as well. John, those are all the questions. I really appreciate your time.